Places, please. Quiet down. And here we go. And roll camera.
Okay, hello everyone. David here, and we are talking today about how news affects the market. So, as we start to dig in here, look, a lot of you who have watched the market for a while may already have a sense of how it reacts to news. This was a topic that was requested by our subscribers, and I was asked to present on it. And there are probably a lot of ways to go about it. Now, there's a commonly held view among a lot of traders that many times, even if we know the news in advance, we can't always anticipate how the market is going to respond. And that's a view I share. So this won't be a session where I'll tell you when we get this type of news, then you'll get this type of reaction. However, what we can talk about is the transmission mechanism by which news affects the market. For those of you who want a better understanding of what's happening under the hood, we can also, once we get through that, I'll show you some news-based trades that I've made over the last couple of days. Right, Honeywell was down on earnings yesterday. I used that as an opportunity to buy some. It was up pretty decently afterwards. I bought some Google today. Now, when we look at this, and let's look at some reactions, right? This was earlier in the week, right? We had Microsoft selling off on an earnings beat, right? Google did the same day, right? Now, at the end of the day, this was on Wednesday. Right, earnings was Tuesday evening. The first time it traded was Wednesday, but we opened lower and closed even lower. So part of that was the reaction that the whole market had to FOMC, but part of that was due to earnings, even though we got an earnings beat. Right, and then the same day, right, the same day, Starbucks gapped up on an earnings miss. So that wasn't the whole market taking it up. That was, again, the stock opening up on a miss. So it's certainly not whether it beats or misses expectations. Now, the overall market decline hit Starbucks later in the day also. And we'll talk about those reactions in a little bit. But look, these news and events, right? We can have a lot of different types of news, right? We can have a news that impacts an individual stock, a whole sector, the broad stock market. We can have news that that impacts other markets, right? The forex markets, the bond markets, commodities markets, and we want to dig into kind of why, right? As we think about how to understand this transmission mechanism, it makes sense to dig into, well, if stocks are going to move based on news, why? So you all know the difference between theory and practice, right? Nothing in theory. Right. But we do need to spend a few minutes talking about the theory of how stocks are affected. Right. And the news is going to affect their valuation. We're going to talk about stock valuation at least briefly here. Just realize this is a huge, deep topic. This one of the classic books on the subject is 704 pages long, so there is certainly a lot of information on how one values a stock. But as we dig into this, right, the the typical way that this is done, and let me get myself out of this spreadsheet. Right, the typical way that one looks at valuing a stock is by discounting the future cash flows. Right, so one of the core ideas as a holder of stock is that you have a claim on that company's future cash flow. But the future cash flows need to be discounted to present value. That is, $1 next year isn't worth $1 today. If I can stick $1 with the U.S. Treasury, where there's basically no risk at all, then I can get $1.05 back a year from now. So we have to discount the cash from next year by about 5% to figure out what that cash from next year is worth today. Everybody with me so far? Now, using that same logic, the cash from 2 years from now, and if we're looking at a company that maybe makes $1,000 right next year, and $2,000 the year after that, right? The stuff from the year after next, well, you have to discount it by 5% just to figure out what it's worth next year, and discount it by 5% again to figure out what it's worth, right? What the cash from 2 years from now is worth present day. And so the stuff from 3 years and 4 years gets discounted even more. It's basically compounding in reverse, right? For the funds from many years from now. So the theoretical impact of news, right? If we use something like a model like this, and many investors who invest based on fundamentals will use a model of expected future cash flows to figure out what the stock might be worth, right? If an investor is using that and gets new news, the question will then be, how does that news affect the value of the company? So any news that might suggest different cash flows, right? The company's growing, selling more product, right? They're going to bring in more cash. The company's reducing expenses, and again, they'll bring in more cash. The company had their main production plant shut down because of an FDA violation. Well, they're going to be making less money, and then you can factor in what that will do to the value of the stock. Additionally, right, any change to the expectation on interest rates, and that's a big part of what we're seeing with today's sell-off, right? Any change to our expectation of interest rates will change the amount by which future cash flows are discounted. Remember, when you go out into out years where you've got to discount this multiple times by an annual rate, right? That discounting gets compounded. So when you get action like we saw today, where our job numbers came in hot, and job numbers coming in hot is going to make it seem even less likely that the Fed is going to be able to lower rates here in March, and maybe even push it out even longer if the labor market not only, right, keeps adding people, but also the average hourly earnings went up a lot, and that's going to be labor market inflation, which is what the Fed's trying to quash, right? If that inflation is still out there, they're not going to be able to reduce rates, and that will keep the rates high, and that means the the amount by which people are going to expect that that they have to discount in their models stays high, and that means that future year earnings are going to be reduced. So you may be familiar with this idea that that high rates disproportionately impact tech companies, right? And you'll often see that. You'll often see that that when rates change, you'll see even more of a move in tech stocks than you see in others. Now, that's actually a phenomenon for growth stocks, right? Growth stocks, small companies which are growing rapidly, may not be making a lot now, but they expect, right, to grow quickly and earn a lot more several years from now, right? That means a lot more of their valuation, a lot more of the value of the company is based on what they might earn in the future and not what they're earning today. And that means a lot more of their value is discounted by the rate. And so that means that the value of those companies is even more impacted by rates. So you get two types of news, right, that can impact an individual stock, right? One, anything that that might affect its operations and therefore how much cash it might bring in, and anything that impacts our assessment of the rate at which we need to discount those cash flows to value the company. So if we go through that, right, we can have that company specific news, and really it can be anything. It can be earnings. It can be an adverse announcement. It could be, it can be announcing monthly sales outside of those things. It could be a new product announcement. It could be hearing that they fired their CFO unexpectedly, and all of a sudden people have to question whether those expectations for their cash flows are really accurate, right? So all of those things go into figuring out what a company might be worth based on its individual performance. Now, news about the industry or impacts the industry can also affect it, right? Can affect the individual companies. Now, that can happen in a bunch of different ways, right? And this is where you could imagine that that things things could be interpreted either good or bad, the same news, based on how you view it. So if we come and we get Walmart's results, let's say, and they're positive, now we want to figure out what that means for Target. Well, if Walmart does well, as an example, do we look at that and say, well, the consumer's doing well, discount retail is doing well, and therefore therefore Target should do as well, do well also? Or do we interpret that to say, well, Walmart's doing well, maybe they're taking business from Target? And if you're going to trade based on that news, you could have multiple different views on what it means until we actually hear from Target. And that's a spot where you'll see people often disagree. And one of the reasons why we can see moves multiple different ways in reaction to news. And then, of course, broad economic news. So we already talked about how that broad economic news can affect interest rates, right? But broad economic news affects the market in lots of ways. So if we get broad economic news that suggests we're going into recession, Well, that might impact what we expect the Fed to do with rates, right? That they will lower rates to stimulate demand, but at the same time, we're going to look at that, or traders are going to look at that and say, well, if we're going into recession, people are losing their jobs. That's going to impact the cash flows of companies that sell things to those people who've lost their jobs, right? And they may not make as much, right? And if we look at banks, they may have folks defaulting on loans. All of these things from the broad economy, right, can affect the expectation of an individual stock, right, through both of those theoretical transmission mechanisms. That is, through our expectation of their cash flows, and potentially, if that broad economic news impacts or has to do with rates, then through that discounting as well, right? So that's the theory, right, of how this stuff works. Now, you have probably heard the quote, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." Right? Often attributed to Benjamin Graham, but sometimes attributed to Buffett, sometimes attributed to other folks. So Buffett has that in one of his books, but attributing it to Graham when he said it. Nothing in the stuff published by Graham has the exact quote, but that's besides the point. The important thing here is the sentiment, right? The true value of a stock, right? The value generated by its cash flows may eventually be recognized by the market in the long term, and investors will look to buy companies that they think will eventually be worth more than they're worth today. But in the short run, it's more of a popularity contest, and that introduces a different set of dynamics in the market. Right? It introduces it into the way that the market reacts to new information, because some people may be viewing it through this disciplined lens of someone building a model of what they think the market is going to be worth. Remember that going to a particular value in the long run doesn't mean that anybody's model for what they expect future cash flows to be is going to be right, but eventually, if a company is worth a lot more because of the cash it generates, then the price will likely eventually go up. But there are a lot of other folks who are trading short term on supply and demand who are going to behave differently, right? That's the voting machine nature of the market, and it's a popularity contest. Perhaps a better way to think of individual securities in the short run is as some sort of fashion good, right? Nobody knows for sure what the haute couture set is going to prefer next season, but designers try and figure it out and roll out designs hoping that they've nailed whatever the fashion zeitgeist is. So think of Microsoft after earnings as the latest design from the house of Microsoft. Right? And those who initiate trades short term after news are reacting to that new design. They may love the quarterly report, they might hate it, right? So after all, Microsoft did beat and sold off at the same time. So you might think that that people are going to like a beat, just like we looked at earlier. But the short-term traders, right, they want to buy a stock purely because they think that any upward momentum may carry it further, and the opposite for shorts. With anticipated news, right, taking trades ahead of some expected news event, some may already have put on trades ahead of time, and when they get their expected move, they're just going to take the profit and not try and project what's going to happen after, or just get out and take the loss if it goes the other way, right? If the event achieves their price objective, then they may get out. That can create a contraforce, right? You get a positive news, the market initially goes up, right? But if the people getting out and they're selling, in the case of something that's gone up, overwhelms those trying to chase the new move, then that can lead to that buy the rumor, sell the news reaction that we often hear talked about. Meanwhile, at the same time, we have those more disciplined investors taking action as well. They'll buy a stock when it reaches their target objectives. But when they see it trading at a discount, like I did with Honeywell, getting knocked down on earnings yesterday, right? Then, if it trades at a discount to a perception of value, then I'm going to jump in and buy it. Again, if disciplined, they'll probably first go through the exercise of seeing if whatever news is out there changes their model, but once they see that, once they figure that out, then and if it hasn't changed or it still looks attractive, then they'll just jump in and take some action. Right. So in addition to all of that, right, the options market structure also impacts the reaction. Right. So if you've been looking at any of these webinars we've done recently with Brent from Spot Gamma, right? The whole notion of that, right, is that option market makers need to be hedged, but the amount they need to hedge any options contract goes up and down with the price. And so if we get a really large price discontinuity on some news event, then the amount that they need to hedge, right, changes. So price goes up, and they may need to hedge even more to the upside than they were before. So the price goes up, and the options market makers need to buy some more, and that sends the price up, and then that gets the whole FOMO MOMO crowd trying to chase things because they think price is going to go higher, right? That gets them buying, and things can cascade to the upside, right? So the nature of existing options positions in the market before any news event can also affect things. How much FOMO folks feel will affect things, and that all comes the FOMO piece really comes down to what's going to be the fashion reaction. Then you get the disciplined traders mixed in, and you've got the option structure, and all of a sudden it's really easy to see why you can't really anticipate what the market's going to do in response to any particular trade. And that's why, as I said at the outset of our session, that I can't tell you with any particular news what the market's going to do, but hopefully I can give you at least a little better idea of how and why news causes the market to move, and maybe that'll help make it easier to follow along when things happen. So this is Apple, right? And you can see Apple had some lows at this Voodoo Fire line here earlier, back in January, right? And then again, an earnings beat that sent the market down, and you can imagine if you followed their report why folks may have been a little underwhelmed, but it was a beat that sent Apple down. But where pretty much right to the fire line, and then it's recovered here intraday. Now, whether you view that as a move up from the fire line or just a move up from prior support, look, this is not people sitting there and trading this longer term on a fundamental basis. This is technical, right? This doesn't have anything to do with the news other than the fact that it went down after the news and people said, hey, 180, that's a level where I'll buy. And they bought it. That's all it is, right? So again, it's, in my mind, this isn't the news that sent it up. It's technicals that sent it up, right? Google beat on Tuesday evening before, right? We gapped down on Wednesday after their beat, sent it down further, right? On the FOMC later in the day, sent it even down further here today on the broad market news, right? Before it recovered from a voodoo tree line. So that's the kind of action that that we tend to see, and that's most of what I had to show you. So if you guys have any questions, anything I can talk about with you, now certainly would be the time. Let me know. Otherwise, we can. In the meantime, I can bring up Honeywell. Right. So this gap down. I didn't get it at the dead low, but I did pick some up yesterday on the gap down, and you can see it's trading decently higher here today. I probably should flip a little out. I did pick up some Google today, not as a trade, picking them up in the investment account, but let's see. So Paul is asking, what is my email address? You can reach me, david@simplertrading.com. That was an easy question. Well, I appreciate, as always, y'all spending a little bit of time with me here in the Simpler Essentials room. And I look forward to seeing you all again soon. Until then, as always, good trade.
Is it all over, Rock?
I guess so.